Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500, and we're going to be looking at some macroeconomic indicators that we can follow to help us better identify when the S&P 500 has bottomed. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. We do have an Into the Equityverse Telegram channel, which you can find a link to in the description below. We also have a sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So in this video, we're going to first start by just simply looking at the S&P 500. We're going to go through US interest rates. We're then going to look at the inflation data. We'll then look at the unemployment rate, and then we're going to look at how we can tie all of those things together to better identify macroeconomic indicators to help us show when the S&P has bottomed. Now, one thing that I think a lot of people make the mistake of doing is assuming that you have to wait until a new all-time high in the stock market before you're making money again. But this is just simply not the case. Of course, this is just simply not the case. For instance, people who bought, index funds at, let's say in 2009, it's not like they had to wait until 2013 in order to see some type of return. The key thing is knowing when to start aggressively deploying back into the market so that you can sort of ride that wave back up. Now, of course, picking the bottom is sort of a fool's errand, and I'm not going to claim that we're going to be able to pick the bottom, but we will at least look at some macroeconomic indicators that should help us identify where the bottom is. So this is the S&P 500 going all the way back to the 1800s. And I mean, you can see that ever since really the 1940s, we've just been in one massive bull run, right? I mean, of course, we've had some brief bear markets along the way, but it's just been one massive bull run that we've been witnessing. Now, the question is when will we actually find some type of a bottom? Now, these are 12-month candles, and you can see where we currently are, okay? And you can also see prior moves that took us down even further than how far we've gone down at the current time, okay? But what we want to do is we want to look at some macroeconomic indicators. Now, the first thing we're going to look at are interest rates. All right, now interest rates are important because it essentially defines how cheap money is, okay? So if you're running a company and you want to take out a loan, you want to borrow money, obviously interest rates are important to you. The higher the interest rate, the harder it is to get money to grow your business. Pretty simple, right? Interest rates go up, it becomes more expensive to get a mortgage, right? Your mortgage rate will go up. Now, when we think about interest rates, how does it necessarily affect the markets? Okay, so we know it can affect you as a consumer, but how does it specifically affect the markets? Well, again, if you are a company and you no longer have access to cheap capital, then you cannot expand as quickly as you might have been able to when you did have access to cheap capital. Okay, so why then would we see why would we see interest rates go up? Well, the reason interest rates are currently going up is because inflation is going up. Okay, and there is a few times in history where we can see similar things having occurred with inflation year over year. So this chart shows United States inflation rate year over year. We just got some new inflationary data just a couple days ago or a few days ago, and it came in at 8.6% year over year. There were many people that were hoping that March more or less marked the top of inflation because we actually had, the month after we saw the inflation come back down a little bit. If we zoom in, you can see that it hit this local top at around 8.5%. We then came back to 8.3%. And I think a lot of people were sort of hoping that we were going to be coming back down, but you can see that we are continuing our ascent upwards in terms of United States inflation year over year. It's not really that surprising considering how elevated housing costs are and the fact that U.S. oil continues to go up on a regular basis. Okay, so if inflation is going up, that's a problem, and the Fed has a mandate. They need to get this under control. Unfortunately for us, the Fed cares much more about inflation than it does our portfolios. Now, at the end of the day, inflation is a very important thing to address. So I'm not trying to minimize that. But the point is you need to understand one simple concept, and that is don't fight the Fed, right? Do not fight the Fed. this is a lesson that many generations before us have learned the hard way. And you can see the lessons they learned and try to learn from them. So do not fight the Fed. What does that mean? Well, it means that as long as the Fed is raising interest rates, then there is a decent chance that the bottom for the stock market is not necessarily in. Now, when I say that statement, it's a very broad generalization. What I mean to say is this, and there's some lagging indicators here, even with interest rates, okay? What I mean to say, as long as inflation has not peaked, right? As long as inflation has not yet peaked, we should not assume that the bottom is in, not with any confident stance, okay? So why do I say that? So I'm gonna show you that right now, but I really want to talk about inflation, the Fed's response to inflation, and how it affects the S&P 500. So you have interest rates going up, and by the way, I mean, think about all the havoc interest rates going up has caused so far, but just look where we are compared to where we've been in the past. I mean, it's just kind of silly to some degree. But interest rates are going up, inflation is going up, so interest rates are fighting inflation, which is going up. If you look at interest rates overlaid with inflation, this is what you get. Okay? So, for instance, in this chart, if you look at the white line here, this is US interest rates, and the orange line is inflation. So you can see that, during periods of high inflation, which is this orange line, interest rates in general are going up to try to combat that inflation. And as long as inflation's coming down, interest rates can then come down because they no longer need to combat inflation, and therefore we can lead into another expansionary time where we come out of a recession and we just have a lot of growth in the U.S. economy. So this is what it looks like, when you're looking at high inflation, the interest rates go up. And now again, look, we're looking at very high inflation. Interest rates are going up in order to combat it, and they are likely going to be going up for some time. We are going to have, I believe, tomorrow, we're going to get a report from the Fed, which will tell us how much they're going to raise interest rates this month. I know a lot of people are assuming 50 basis points. There's even some speculation on 75 basis points. But needless to say, they're going to be raising, at least 50 basis points, more than likely, at least for the next 2 months, if not 75 basis points. But if they do raise it 75 basis points, this will be a somewhat change in the communication that we've previously received. So with all that in mind, then we need to go figure out, well, why does this matter with relation to the stock market? Well, if you go look at the S&P 500 and you overlay the S&P 500 with inflation, this is what you get. Now, what's interesting is there are previous periods of time where inflation went sky high. And we can look to see what happened during that time with regards to the stock market. So the first area that we can clearly look at is the 1970s, okay? And you can see we had an inflationary decade that essentially started in 1972, and we didn't come back down to 1972 levels until about 11 years later. So we had an inflationary decade, okay, from 1972 until 1982. Now, during that period, you had sky-high inflation. However, the bottom occurred relatively early in that inflationary decade. Okay, so if we look at where the bottom occurred from when inflation really started to go up, the bottom on the S&P 500 occurred in 1974, really late 1974. Okay, now the reason why that's important is because if you look to see where inflation was at the time, that is where inflation hit its local top. Okay, so inflation topped at around 11.5% year over year, or somewhere around there, and that marks the S&P 500 bottom. Now, unfortunately, the S&P 500 did not actually see a new all-time high until about from 1973. It took about 7 years to see a new all-time high. However, one of the reasons that we had to wait so long is more than likely because inflation started to go back up again in the late 1970s, and therefore it was something that we had to combat once again. And you can see, if you go back and look at say interest rates, you can see even in the 1970s, interest rates were going up, and then we started to come back down, but then inflation started to go back up again, and therefore interest rates had to go up again. So this really stunted economic growth because, again, the Fed was fighting inflation, and therefore the mantra of don't fight the Fed, okay? So if we go back over here, it might beg the question, well, what happened during the second peak of inflation that actually went higher than the first? Well, the bottom for the S&P was already in, okay? It sort of just slowly went up from there. So if you were DCAing into the S&P 500, at this time in the 1970s, even though it took a while to get to a new all-time high, you're still watching your portfolio go up. So you shouldn't necessarily measure the performance based on some irrational mania phase all-time high, but just measure it from where you're really starting to, where a lot of your regular DCAs of the stock market are potentially coming in. Now, there is a lot of evidence to suggest that in the stock market, lump sum is better than dollar cost averaging. There's a lot of data to back that up, and who am I to argue with the data? Now, when you look at the second peak in the 1970s, you will in fact notice that the S&P from that point, from this first peak of inflation to the second peak, was up about 73% or so, okay? So still really good returns. You don't have to wait for a new all-time high before you're watching your portfolio go up again, even if you do get double peak inflation like we did in the 1970s, all right? But what you'll notice is that the S&P bottomed when inflation peaked. And why did it bottom when inflation peaked? You go look at the interest rates. That's when the interest rates started to come back down. Okay? So what you really want to look for, you want to look for when is inflation really starting to sort of hit its peak. And that's going to take into account a lot of things. I'm not going to go through all of them here, but when you have the prices of housing and gas, et cetera, when everything's going up quicker than it ever has been, or quicker than it has in a long time, you should not assume that inflation is necessarily peaked, okay, year over year. This is, we haven't seen housing market prices go up this quickly, in basically since, or even, I think they even went up quicker last year than they did in 2008. So we need to understand that it's going to take some time for inflation to peak. And the idea of constantly calling the bottom on the stock market is relatively silly because no one really knows where the bottom is. But the important thing is when is the bottom, right? Not where is it, just when is it? Because whenever it occurs, that's the time where you could start getting more aggressive and then hopefully watching your portfolio go higher. I mean, imagine you had a choice. Would you rather have a slow bleed over a long period of time where you have to just sort of wait, or would you rather have the Band-Aid ripped off and have the S&P drop as far as it's going to drop, and then you can then start investing again? So the point is not necessarily where it occurs, but when it occurs. And I think in order to figure out that, we have to then follow inflation year over year, and it's currently coming in at 8.6%. Now, if you look at the 1940s, you'll see a very similar thing occur. Okay, so if you go look at the 1940s, you will see the S&P also hit a bottom in 1942, and we also had a second peak in inflation a little bit later. But what's interesting yet again is by the second peak of inflation, the S&P was up over 113%. And it was that first peak in inflation that led into that, that bear market that the S&P had, where we went down a significant amount. And then once we hit that, we hit a local bottom, and then we continued to go up. And then once inflation was under control, we went on a fairly massive bull run that lasted until inflation started to go back up again. Okay, so again, we find ourselves in a similar predicament. We are coming off a fairly nice bull run. Inflation's going up again. Okay, wherever inflation peaks, there's a good chance that will mark the bottom for the S&P, wherever it is. Right? And the actual number is irrelevant to some degree. It's just when it occurs, not what the value is. It's just when it occurs, because at that point, again, you could theoretically get more aggressive. Now, if you continue this on, you could also look at things like the unemployment rate. Now, the unemployment rate is is a lagging indicator, so I don't think we should put too much stock, no pun intended, into this indicator. But one of the things you'll notice is that the unemployment rate, so this is the orange line here, and we're overlaying it over the S&P 500, the unemployment rate tends to peak after the stock market has bottomed, okay? So if you look here, it occurs about 6 months before. This is why I've always said the economy will recover after the stock market bottoms. You can see this was about, these are monthly candles. I mean, this occurred about more than half a year later. The stock market bottomed, and then unemployment didn't peak until about half a year later. Unemployment has not started going up yet, right? But when it does go up, it can go up, relatively quickly. And when that occurs, whenever unemployment peaks, the bottom for the stock market could have been in half a year before. Okay, so we need to consider that. We need to consider that unemployment is a lagging indicator. The stock market will start to price in a recovery even before the economy actually recovers. Now, the reason unemployment has not been going up, I think, yet, is because we are just at the beginning phases of a recession. I do think we're already in a recession now. That should become more, more set in stone here as we get in more data at the end of the quarter. But because we're experiencing a recession, then we should assume that there are going to be more layoffs. And if that's the case, you should see unemployment start to spike. And then when unemployment spikes, that could lead to the Fed wanting to do something about switching from being hawkish to being dovish yet again. But they can't really do that until inflation peaks. But it's all tied together, because if unemployment goes up, then people aren't going to have as much disposable income to buy all these things that are skyrocketing in price in the first place. So to some degree, the remedy for high inflation is just high prices, because people will just get priced out. They'll no longer be able to buy that stuff, and therefore eventually prices will come back down because the supply perhaps stays the same, but demand will in fact go down. Of course, it's more complicated than that because we're also having supply chain issues. But I'm just trying to show you how everything sort of ties back together, and how going into a recession, we're likely going to see a spike in unemployment in the coming year. Probably in the next few months, we'll probably start to see this spike. Whenever it hits a local top, it'll likely occur after the stock market bottoms. The stock market likely will not bottom until inflation has peaked, right? Inflation has peaked, and inflation will not peak until people can no longer afford to really either have as much disposable income on a lot of these things, or they're just simply priced out, right? They're just simply priced out of everything, and therefore the prices start to come back down. Again, it's a little bit more complicated because you also have supply chain issues, but you can begin to understand how everything is sort of correlated to one another. And so when you go back to the S&P 500, right? If you go back over to the S&P 500, the only question is when will inflation peak? Because we know, right? We know that historically the bottom occurs once inflation has already hit a local high. Okay, so in this example, you can kind of see that play out, and we've talked about that throughout this video. So we'll keep an eye on core inflation. We'll keep an eye on when is it actually going to peak. When it does, the Fed will likely begin to pivot. They might pivot even before it slightly peaks if they think it's going to get under control, but it's going to also tie back into the unemployment rate. I hope this video makes sense. I know it's somewhat convoluted, but I do think I've tried to explain why I think that picking the actual bottom for the stock market is somewhat silly. What's more important is figuring out when it's going to occur. And in order to understand that, you have to look at a lot of these macroeconomic indicators. Thank you guys for tuning in. Make sure you subscribe. If you're not subscribed, give the video a thumbs up. I'll see you guys next time. Bye.